But first up, let's get a conversation going now. And we have Sunil Tirumalai joining us. He's Executive Director at UBS and joins us now to really discuss where the markets could be headed, as well as how, they're really reading the Q1 earnings season that just got done as well. Sunil, it's always a pleasure to have you on the show. Thank you for joining us today. I do want to begin by asking you about the Q1 earnings season, since that's completely done now. Take us through your review of it and, where do you really see the hits and misses coming through this time?
Yeah, thank you, everyone, and good morning to all your viewers. Yes, I think the comparison quarter last year, of course, was very supportive for this year's YOY comparison, right? Because that was the peak inflation quarter, and it wasn't surprising to see profit growth, EBITDA growth, operating profit growth hitting really, really strong numbers. But at the same time, those were also kind of in the expectations, right? So, so we actually, found that versus expectations, this was probably one of the weakest quarters, right? Usually versus sell-side expectations ahead of the quarter, you have about 60% companies, beating estimates. I mean, it might sound like a very high number, but that's how, sell-side pre-quarter earnings expectations work. But against that, we had 50 to 53% companies only beating, and more than half the stocks fell or underperformed on earnings recovery, on earnings release, which basically means that even the market was a bit disappointed. Without getting into too much detail, as you said, it's now more than a week old, the earnings being closed. I think the worries for us are coming from the fact that there seem to be non-RM cost pressures on margins, which aren't allowing a full recovery, right? So over the last 12 months, we've seen close to 600 basis points reduction in raw material costs for the non-financials, in BSE 200, but the EBITDA margins have gone up only about 400 basis points. So we are seeing pressures on employee costs across sectors, not just, even outside of big employers like IT services. We are seeing employee cost pressures across financial services, across consumer, across some of the auto companies, etc. And we're also seeing SG&A expenses staying elevated. So yeah, I think if you look at within the results announcements and the numbers that came through, I think clear upgrades are still being seen in financials and to some extent autos, but broad-based cuts are happening, right? Close to 28 to 30 stocks out of 50 stocks in the nifty have seen earnings cuts for FY24 and FY25 over the last 3 months, over the result season. So there are broad-based earnings cuts. The nifty earnings, EPS is coming off, but not as fast as many stocks are seeing cuts, because it's being held up by a few sectors like financials.
Okay, Sunil, that's quite interesting. Seeing pressures, SG&A and employee costs, interesting insights there. The note that you folks put out, I think one of the last lines that kind of summed up the sentiment that really stayed with me, and I want to repeat that for the benefit of our viewers. You explained that you're cautious because of extraordinary valuations versus an ordinary outlook. Now, that's a pretty somber thought, right? So expand on that point. You mentioned some of the EPS cuts that are coming in, and we've been trading at around 19 times, but there's been a lot of money chasing stocks. So could we go through a period where, the market remains elevated or at least range bound, if not a rally, irrespective of the fact that earnings are now not as glorious as perhaps we thought earlier?
So, let's start with a global perspective, right? I think our view is that equities globally are being, this has been a year of, massive flow of money into equities globally, and India has, of course, been a beneficiary of that. But our view is that, sooner than later, we should start seeing downsides and outflows from equities globally into other asset classes, particularly fixed income. Right. So in that context, I think that's what is likely going to drive a downside risk for the Indian market. However, our call is more on India versus other emerging markets being in an underperformed territory. So just elaborating on that. So if you look at the last 4-5 years of performance across emerging markets and where India stands, right? So I would start from pre-pandemic because each country went into the pandemic and lockdowns at different points in time. India is not, superior. It's actually at or below, other emerging markets median average. When I look at top line growth, when I look at profit growth, when I look at operating profit growth, etc. If I look at 2024 and 2025 calendar years or FY25, FY26 for India, we normally talk about 12, 13, 14, 15%, growth for India. That's actually lower than what other emerging markets are, at least what the sell side is expecting, right? So consensus, right? So we have, all that's said and done for China, it is still coming out of a really tough 2022 when they had their lockdowns. We have the big technology-driven markets in Korea and Taiwan, are seeing not just a cyclical rebound but also a structural rebound because of AI-related demand, etc. So overall, in that context, even on the forecast basis, India doesn't seem, very strong, contrary to what, the perception is, contrary to what we would like to believe that, in India being the fastest growing economy should also have the fastest growing stocks. But at least on earnings, it looks, pretty average from an EM context.
Sunil, what's your EPS growth estimate for FY24, FY25? And is there a risk to that, given the recent CPI inflation print above 7% and the possibility that the rate cut from RBI may not be as forthcoming as we were earlier anticipating?
Yes. So I think, we are somewhere in the, 10 to 12% range. I think consensus is somewhere in the 14-15% range for the next couple of years. So there is, some downside to consensus that I see. And, just to give you a comparison, consensus for the whole of emerging markets is probably in the range of 16 to 18%. Now, yes, you're right. I mean, there are, so as I mentioned at the start of this, discussion, there are cuts happening broad-based across multiple sectors. But financials have been, holding up overall aggregate index EPS because they're still seeing some tailwinds of margin expansion. We're not sure how long that could last, and that support for index EPS could start closing.
Sobering thoughts. Just to clarify, 10 to 12% earnings growth over the next how many years, Sunil, or is it just FY24?
2 years.
Over the next 2 years. Okay, got that.
Yeah.
Thank you for joining in. Appreciate your view, and we look forward to the next chat that we have. All right, there you have it, a view from UBS, and they are definitely in the cautious camp when it comes to the Indian market. We'll take a break. On the other side,